Picture a world where your money has the incredible ability to grow and multiply itself exponentially over time, creating a pathway to unimaginable wealth. Today, I invite you to step into the captivating world of compounding, where small investments can lead to extraordinary financial achievements. Get ready to embark on an exciting journey where we will uncover the secrets of compounding and equip you with the tools to transform your financial future. In the world of personal finance, one concept stands out as a tried and tested path to long-term wealth creation, and that is compounding. The concept of compounding involves reinvesting your earnings and allowing them to generate additional returns over time. By harnessing the power of compounding, individuals can potentially accumulate significant wealth and achieve their financial goals. In this video, we will delve into the principles of compounding and its benefits, and discuss the 7 best compounding assets that can pave the way to financial success. At the end of the video, I'll also give you a surprising gift. But before discussing the best compounding assets, let's quickly understand what compounding truly is. Compounding is often described as the eighth wonder of the world because of its remarkable ability to exponentially grow investments over an extended period. Compounding is the process of reinvesting profits, dividends, or interest earned on an initial investment, allowing them to generate further returns over time. The magic of compounding lies in its ability to generate earnings on both the principal amount and the accumulated returns. As time passes, this compounding effect accelerates, resulting in significant wealth accumulation. The compounding effect can be aptly described as the snowball effect of wealth accumulation. To fully grasp the potential of compounding, let's consider a practical scenario. Suppose you invest $10,000 in an asset that generates an average annual return of 8% over a period of 30 years. In the first year, your investment grows by 8%, adding $800 to your initial $10,000. The new total becomes $10,800. In the second year, the 8% return is applied to the increased amount of $10,800. resulting in an additional $864. The total value now stands at $11,664. The compounding effect continues, and the 8% return is applied to $11,664, generating $933.12. The total value rises to $12,597.12. As the years progress, the growth becomes more significant due to the compounding effect. By the end of 30 years, the initial $10,000 investment would have grown to approximately $100,626. Interest is not only earned on the initial principal, but also on the accumulated interest from previous years. This compounding effect dramatically amplifies the growth potential of investments over time. Over a long-term investment horizon, compounding can generate substantial wealth. Now that we have gotten to understand compounding, let's now discover the 8 best compounding assets that have made the wealthy and the rich people we see today. 1. High-yield savings accounts. A high-yield savings account is like a regular bank account, but it gives you more interest, meaning your money grows faster. It's one of the easiest ways to start investing because you don't need a lot of money up front. Although the returns are not as big as other investments, it's safe, and you can access your money anytime. Imagine you put $10,000 in a high-yield savings account with a 2% interest rate. After 10 years, your money could grow to around $12,189. The interest keeps adding up over time. These accounts are great for short to medium-term goals or as an emergency fund. They're safe, easy to use online, and help your money grow. 2. Stocks. Investing in stocks and equities is a popular long-term strategy for wealth generation through compounding. Historically, the stock market has outperformed most other asset classes over extended periods. Companies with consistent growth, strong financials, and a competitive edge tend to deliver superior returns over the long term. By investing in a diversified portfolio of fundamentally strong companies, you can harness the power of compounding. Over the years, stocks have provided average annual returns of around 7 to 10%. Let's say you invest $10,000 in a diversified portfolio of stocks. Assuming an average annual return of 8%, after 10 years, your investment could potentially grow to approximately $21,589. 3. Dividend-paying stocks. These are stocks from companies that share their profits with their shareholders through dividends. They offer regular income and a chance for your investment to grow. Here's how they help you build wealth. Regular income. You get paid a portion of the company's profits regularly, usually every few months. You can use this money to buy more shares, which makes your money grow faster. Growing value. These stocks can also increase in value over time. When the company does well, the stock price goes up, giving you extra money. By reinvesting your dividend stocks and letting the stock price go up, you benefit from both regular income and growing value. To make smart choices with dividend-paying stocks, look at things like how much they pay in dividends, how much of their profit goes into dividends, and how healthy the company is. It's often a good idea to pick well-known companies that have a history of paying dividends and increasing them year after year. These are often called dividend aristocrats. For example, let's say you invest $100,000 in a mix of dividend-paying stocks. On average, they pay a 3% dividend, which means you get $3,000 in dividends each year. Over 20 years, if the stock prices go up around 5% each year, your investment could grow to $278,647. 4. Bonds. Bonds are like loans you give to governments or companies, and they pay you back with interest. They're safer than stocks, but usually don't give as much profit. They're good for steady income and protecting your investments from big market ups and downs. The compounding in bonds happens when you take the interest they pay you and put it back into the bond. For example, let's say Mark puts $100,000 into a bond that pays 5% interest every year for 10 years. Each year, Mark gets paid interest, and he puts it back into the bond. So each year, the interest is calculated on a little more money. By the end of 10 years, Mark's $100,000 could grow even more because of the interest he reinvested. 5. Precious metals. Investing in precious metals like gold and silver can be a strategic addition to a diversified portfolio. Precious metals have a historical track record of retaining value and serving as a safe haven during times of economic uncertainty. While they don't generate regular income like dividend-paying stocks or bonds, their value tends to appreciate over the long term. It's often recommended to allocate a small portion of one's investment portfolio to precious metals as a hedge against inflation and market volatility. The exact percentage allocation depends on individual risk tolerance and investment goals. A common recommendation is to allocate around 5 to 10% of the portfolio towards precious metals. To illustrate, if an investor has a $500,000 investment portfolio and decides to allocate 10%, that is $50,000, to precious metals, they can consider purchasing physical gold or silver bars, coins, or exchange-traded funds, ETFs, that track the price of these metals. Over a 20-year period, assuming an average annual return of 5%, the investment could potentially grow to around $132,676. Over time, as the value of precious metals appreciates, the investment can compound and contribute to overall portfolio growth. It's important to note that while precious metals offer stability, they can also experience price fluctuations. Therefore, experts suggest a long-term investment horizon of at least 5 to 10 years when investing in precious metals, and holding them as part of a diversified investment strategy rather than relying solely on them for wealth accumulation. Additionally, investors should consider the costs associated with storing and insuring physical metals. 6. Index funds and exchange-traded funds, ETFs. Index funds and ETFs are investment vehicles that track a specific market index, such as the S&P 500. They offer diversification across a broad range of assets, such as stocks, bonds, and commodities, allowing investors to benefit from the overall market's growth. These funds typically track a specific market index, providing exposure to a basket of securities. Through regular contributions and reinvestment of dividends, index funds and ETFs can compound returns over the long term and achieve long-term wealth accumulation. Over the long term, index funds and ETFs have provided average annual returns of around 6 to 8%. Let's consider an investment of $20,000 in an index fund, assuming an average annual return of 7%. After 20 years, your investment could potentially grow to approximately $67,275. By consistently reinvesting the dividends and maintaining a long-term investment horizon, you can take advantage of the compounding effect to build substantial wealth. Before you go, here's the gift I promised you. I hope this helps. In fact, one of the best things you can have at the beginning of your financial journey is a list of the incredible benefits of compound interest that reminds and motivates you every day why you're doing all this for. 1. Exponential growth. With time being your ally, the earlier you start investing, the more time your investments have to grow and compound. Time allows the power of compounding to work its magic and exponentially grow your earnings. Compounding allows for exponential growth due to the compounding effect, and as time progresses, the rate at which wealth accumulates accelerates. This means that even modest investments, given enough time, can result in significant wealth. 2. Passive income. Compounding enables individuals to generate passive income. By reinvesting earnings, individuals can create a cycle of generating additional returns, which can be reinvested again without actively working for it. This passive income can provide financial security and freedom as it continues to grow over time. 3. Mitigating inflation. Compounding acts as a hedge against inflation. Inflation erodes the purchasing power of money over time. As the value of money decreases over time due to inflation, investments that generate returns above the inflation rate can help individuals preserve their purchasing power. 4. Psychological benefits. From a psychological perspective, witnessing the growth of your investments over time can instill discipline and patience. Watching investments grow over time reinforces the importance of staying invested and avoiding impulsive decisions based on short-term market fluctuations. This mindset is crucial for long-term financial success. Compounding is a powerful wealth-building tool that can help individuals achieve their financial goals. By understanding the principles of compounding and strategically investing in compounding assets, individuals can unlock the potential for long-term wealth accumulation. Thanks for watching. Subscribe for more weekly investment tips. Leave a comment below. Happy investing!